Have you ever had one of those moments where you're just standing in the middle of a grocery store aisle, staring at a carton of eggs or, gallon of milk, and you suddenly realize the price has jumped yet again?
Oh, yeah. It's a very common feeling these days.
Right. Or maybe you're scrolling through housing listings on your phone, looking at the current mortgage rates and trying to figure out why buying a starter home suddenly feels, well, like a financial impossibility compared to just a few years ago.
Yeah, you watch the job market tighten up, you see the yield on your high-yield savings account bounce around.
Exactly. And it all feels like this chaotic, entirely unpredictable weather system. I mean, it feels like you're just at the mercy of the economic elements.
But then, if you look a little closer at the data, you start tracing the wires back to the source.
And you realize something profound. It is not the weather. It's not totally random.
No, it's not. There is actually a single massive entity pulling the levers behind the scenes.
It's the ultimate man behind the curtain scenario, right?
It really is. I mean, when you see those mortgage rates spike, or when you notice that companies are suddenly doing mass layoffs, or conversely, going on massive hiring sprees, you're feeling the direct, calculated effects of a highly engineered, deeply complex system.
Wow.
Yeah, we're talking about an institution that has the power to single-handedly influence the economic trajectory of the entire United States, and by extension, the entire global economy.
Okay, let's unpack this.
Right.
Because that is exactly our mission for this deep dive.
Right.
We are taking a comprehensive look at the Federal Reserve, the central bank of the United States.
So known just as the Fed.
Exactly.
Yeah.
We're going to explore how the Fed manages the stability of the banking sector and actively, deliberately steers national economic growth.
And we have some great source material for this.
We do. Our foundational guide for this journey is a massive, incredibly detailed Wikipedia article on the Federal Reserve. It's an exhaustive repository detailing its tumultuous history, its labyrinthian structure, and the incredibly complex monetary tools it uses to do its job.
Setting the tone right away is crucial here, I think, because the Fed is not just some giant passive vault of money sitting in Washington, D.C.
Right. It's not like a Scrooge McDuck money bin where the government just, hoards gold.
No, not at all. It is an active, dynamic mechanism, and it's designed to balance on a terrifying razor's edge.
A tightrope act, basically.
Exactly. On one side of this tightrope, you have the threat of runaway inflation, which destroys the purchasing power of your money, making your savings completely worthless.
Right.
And then on the other side, you have the threat of a complete economic freeze, a deflationary spiral, and a devastating depression.
So the Federal Reserve exists right in that middle space, constantly tweaking the dials to keep the whole machine from just shaking itself apart.
That's precisely it.
But, to understand how the Fed controls the modern economy, we first have to understand why it even exists in the first place.
We have to go back in time.
Yeah, back to a time before its creation in 1913. We're talking about an era in the United States that was, for all intents and purposes, the financial Wild West.
Calling it the Wild West is barely an exaggeration. The history of central banking in the U.S. was not a straight line of progress at all.
It was messy.
It was a series of failed experiments. The founding fathers were actually deeply divided on this.
Right. Alexander Hamilton and Thomas Jefferson.
Exactly. Hamilton championed the first Bank of the United States in 1791 to handle the new nation's war debt. But Jefferson and his allies despised it. They feared a massive concentration of financial power.
So they let the charter expire.
Right. Then they tried a second Bank of the United States in 1816, but President Andrew Jackson famously went to war against it.
Oh, yeah, he vetoed its renewal, didn't he?
He did,
Yeah.
because he believed it favored wealthy elites over common citizens. And what followed was this chaotic period known as the free banking era, where basically any institution could issue its own paper money.
That sounds like a nightmare.
It was. And then there was a fractured system of national banks instituted during the Civil War in 1863.
And without a central steering wheel, without a unified system to manage the flow of money, things were remarkably unstable.
Very unstable.
The 19th and early 20th centuries were punctuated by these massive, devastating financial panics. I mean, we're talking about the Panic of 1873, the Panic of 1893, and the really big one that changed everything, the Panic of 1907.
Right. These were not just dips in the stock market. These were society-altering events. Thousands of businesses collapsed, unemployment skyrocketed, and people's life savings simply vanished overnight.
Just poof, gone. But to understand why these panics kept happening with such brutal regularity, we have to look at the core vulnerability of the banking system itself.
Yeah, we have to talk about fractional reserve banking.
Let's break that down, because I think a lot of people still operate under a misconception about how their local bank actually works.
Oh, for sure.
Banks do not just take your paycheck, put the cash in a little metal lockbox with your name on it, and guard it until you come back.
Far from it. When you deposit money, the bank takes the vast majority of those funds and immediately invests them.
Usually by lending it out, right?
Exactly. They lend your money out to other people, to a family buying a 30-year mortgage, or a local entrepreneur taking out a 5-year loan to build a restaurant.
Right.
The bank is legally required to keep only a small fraction of its total deposits in liquid cash, basically, in reserve. That's the fractional part of fractional reserve banking.
And under normal, everyday circumstances, this system works perfectly, right? Because statistically, not every single depositor is going to walk into the bank and demand their money back on the exact same Tuesday.
Right, exactly.
I always think of it like the coat check at a massive Broadway theater.
Oh, that's a good analogy.
Yeah, you go to see a play in the dead of winter, you hand the attendant your heavy winter coat, and they give you a little numbered ticket. Now, the actual coat check room is surprisingly small. They pack those coats in tight. But the system functions beautifully because people leave the theater at slightly different times, or they dawdle in the lobby, or they grab a drink. The attendants have time to fetch the coats as people casually trickle out.
Makes sense.
But imagine someone yells fire in the middle of the second act. Every single patron in that 2,000-seat theater panics, rushes to the lobby, and demands their coat at the exact same second.
Complete chaos.
Total chaos. The attendants are completely overwhelmed. The room is too small to navigate. The system instantly, catastrophically breaks down. And in the financial world, that is a bank run.
That analogy perfectly captures the sheer panic and the mechanical failure of it all. A bank run happens when too many customers, driven by fear or rumors that the bank is going under, demand to withdraw their savings all at once.
And the bank just doesn't have the cash.
Right. It simply does not have the cash on hand. It's not that the bank's assets are gone. It's that the money is tied up in a 30-year mortgage on a house across town.
You can't just chop a roof off a house and hand it over the teller counter.
Exactly. They can't instantly convert that house back into cash. And in the late 1800s and early 1900s, when one bank failed this way, the fear became a contagion.
Contagion is the perfect word. I mean, if you see the bank across the street locking its doors with a mob of angry depositors outside, you don't wait to see if your bank is healthy.
No, you run.
You run to your bank and pull your money out immediately.
And that causes your perfectly healthy bank to collapse. And furthermore, banks during this era would stop clearing checks from each other out of suspicion, which froze the entire payment system.
Wow.
Yeah, in the panic of 1907, the situation escalated so rapidly following the collapse of a massive institution called the Knickerbocker Trust Company that the federal government was completely powerless to stop it.
The government couldn't do anything.
Nothing. The crisis was only halted because J.P. Morgan, the actual man, the private banker, locked the city's most prominent financiers in his private library and personally strong-armed them into committing tens of millions of dollars of their own money.
Just to bail out the failing institutions.
Exactly, to provide the liquidity needed to stop the panic.
It is wild to think about. I mean, the entire financial survival of the United States relied on one incredibly wealthy guy locking a door and twisting arms.
It was a very precarious situation.
That was the ultimate wake-up call for the nation, right? The government and the public realized that a modern, industrialized economy cannot rely on the goodwill and personal wealth of a single individual to save it from ruin.
No, absolutely not. The country suffered from what's called an inelastic currency, meaning the money supply couldn't quickly expand to meet emergency demand.
Right.
And there was a fatal lack of centralized liquidity. They needed a permanent structural solution.
Which brings us to 1913.
Yes, the 1913 solution. The origins of this are quite famous, actually, often cited in financial lore. In 1910, Senator Nelson Aldrich, alongside representatives from the nation's top financial and industrial groups, literally boarded a train under assumed names.
Wait, assumed names?
Yeah.
Like spies?
Oh. Basically, yeah. They traveled in secret to a private resort on Jekyll Island off the coast of Georgia. They spent days secluded there, drafting a comprehensive plan for a centralized banking system.
The famous Jekyll Island meeting.
Right. That Aldrich plan, after significant political wrangling and modifications, eventually evolved into the Federal Reserve Act of 1913, which was signed into law by President Woodrow Wilson.
What's fascinating here is how targeted that original design was. I mean, they weren't trying to manage the global economy or set the price of goods.
Not at all.
The original mandate was a direct, mechanical response to the specific vulnerability of bank runs. They wanted a lender of last resort.
Yeah, a giant reservoir of cash that a struggling bank could borrow from in an emergency so they wouldn't have to lock their doors when the depositors panicked.
And they also wanted an elastic currency, right? A money supply that could physically expand and contract as the seasonal agricultural economy required.
It was essentially designed as emergency plumbing for the financial sector.
Plumbing, I like that.
Yeah, but over the subsequent decades, particularly in the crucible of the Great Depression in the 1930s and later the 2008 financial crisis, that narrow mandate evolved dramatically.
It really did.
Today, the Federal Reserve's responsibilities have expanded to managing the entire macroeconomy of the United States.
Looking at our deep dive materials, the core purposes of the modern Fed are vastly broader than the 1913 vision. Yes, they still act as that crucial lender of last resort to address banking panics. They still maintain an elastic currency.
But now
They're tasked with managing systemic risk in the global financial markets. They regulate and supervise private banks to make sure they aren't taking reckless gambles with depositor money.
Right, and they protect consumer credit rights.
Yeah.
And they serve as the central nervous system for national payments.
What does that mean, practically?
Well, when you deposit a check, the Fed is often the intermediary clearing that transaction between your bank and the payer's bank. They process trillions of dollars in electronic transfers. They even handle the physical logistics, accepting, verifying, and distributing the paper currency and coins printed by the U.S. Treasury and pulling old, damaged bills out of circulation.
Okay, so we've established that by 1913, the founders of this system knew a central bank was absolutely necessary to stop these devastating panics. But, as we discussed with Hamilton and Jackson, Americans historically harbored a deep, almost genetic distrust of a centralized financial power.
Oh, absolutely. A very deep distrust.
You had agrarian progressives out west and in the South who were terrified that a central bank would just be a tool for Wall Street elites to control credit and crush farmers.
Right.
And on the flip side, the Wall Street bankers were terrified that a central bank run by political appointees in Washington would lead to the government micromanaging their businesses and using the money supply to buy votes.
Everyone was scared of everyone else.
Exactly.
Mm.
So how did they construct a system that wouldn't be completely captured by either of these bitter factions?
They engineered a brilliant, highly unusual compromise. The Federal Reserve is not a standard government agency, nor is it a private corporation. It has a hybrid structure.
A hybrid. Okay.
Yeah, in constitutional and administrative terms, it is often described as being independent within the government, not independent of government. It is simultaneously public and private, centralized and decentralized.
Okay, let's pull apart the anatomy of this hybrid, because it's built on three main pillars that balance each other out. Pillar number one is the centralized public face, the Board of Governors.
The Board of Governors is based in Washington, D.C., and it represents the federal government's oversight of the system. It consists of 7 members who are appointed directly by the President of the United States and then must be confirmed by the Senate.
Much like a Supreme Court justice or a cabinet secretary.
Exactly.
But unlike a cabinet secretary who serves at the pleasure of the president and usually leaves when a new administration takes over,
Yeah.
these governors are heavily insulated from the daily churn of partisan politics.
Very insulated. They serve staggered 14-year terms.
Yeah. 14 years. It's a long time.
It is. One term expires every 2 years. So, theoretically, no single president serving a 4-year or even an 8-year term can just sweep in, fire everyone, and pack the board with loyalists to force them to enact economically reckless but politically popular policies right before an election.
And the current chair leading this board, based on the data in our sources, is Jerome Powell.
That's right. And that 14-year insulation is a cornerstone of modern economic theory. Economists across the political spectrum generally agree that monetary policy should be insulated from short-term electoral politics.
Why is that so crucial?
Because if a president or Congress had direct daily control over the money supply, there would be an overwhelming temptation to artificially lower interest rates and flood the economy with cash 6 months before an election.
To make things look great right before people vote.
Exactly. It would create a temporary euphoric economic boom, ensuring their re-election, but it would inevitably lead to massive punishing inflation a year later. The long terms are designed to allow the governors to make unpopular, painful decisions without fear of immediate political termination.
Okay, that covers the folks in Washington. But if you're trying to manage the economy of a continent-spanning nation, sitting in a D.C. office isn't going to give you the full picture.
No, you need sensors on the ground.
Right. And that brings us to pillar number 2, the 12 regional Federal Reserve banks. This is where the decentralized private aspect comes into play.
The architects of the Fed divided the United States into 12 distinct districts, placing a regional reserve bank in key cities.
Like where?
Well, you have the Federal Reserve Bank of Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco.
That's a lot on the East Coast.
Yeah, it's worth noting that this map was drawn based on the population and economic distribution back in 1913, which is why the eastern half of the country is heavily represented, while the massive San Francisco district covers everything from California up to Alaska and Hawaii.
Wow. Okay, so these regional banks are the boots on the ground. They gather economic data from their specific districts, they supervise the local commercial banks, and they interact directly with the private financial sector.
Right.
And here is the part of the Fed structure that often sparks conspiracy theories until you look closely at the actual mechanics. Private commercial banks actually own stock in these regional Federal Reserve banks.
Yeah, that is a factual statement that requires immediate, precise clarification because it is easily misunderstood.
Definitely. Unpack that for us.
So member banks, which are the private commercial institutions where you might have your checking account, are required by law to hold stock in their regional Fed branch. Specifically, they must subscribe to stock equal to 3% of their combined capital and surplus. However, this is absolutely not like owning stock in a publicly traded tech company like Apple or Microsoft.
Right, you can't log on to a brokerage app and buy shares of the Federal Reserve.
Exactly. A member bank cannot sell this stock, they cannot trade it on Wall Street, and they cannot pledge it as collateral for a loan.
Furthermore, owning this stock does not grant these private banks control over the Federal Reserve System, right?
No, not at all. It does not give them the power to dictate national monetary policy. What it does do is fulfill a structural membership requirement, and in return, the member banks receive a statutorily fixed dividend.
Like a payout.
Yeah. For member banks with $10 billion or less in assets, they receive a 6% annual dividend on that stock. For larger banks, the dividend is the lesser of 6% or the current 10-year Treasury option rate.
So it's just a mandated feature of the hybrid public-private partnership?
Exactly. It's designed to ensure the private banking sector has a vested, capitalized interest in the stability of the regional reserve banks without granting them sovereign control.
Okay, so we have the 7 presidentially appointed governors in D.C., and we have the 12 regional reserve banks anchored in the private sector across the country. But having a pulse on the economy and a board of directors isn't enough. Someone has to actually make the medical decisions for the economy.
The actual policy.
Right. How do these two halves come together to actually vote on policy? That is pillar number 3, the FOMC or the Federal Open Market Committee.
The FOMC is the absolute steering wheel of the United States economy. This is the committee that meets every 6 weeks to evaluate economic conditions and actually set national monetary policy, primarily by determining interest rates.
And how many people are on this committee?
The committee consists of exactly 12 voting members.
And the math here perfectly illustrates the compromise we were talking about earlier. All 7 members of the Board of Governors get a permanent vote. So the public, Washington-appointed side always holds the majority. The remaining 5 voting seats go to the presidents of the regional reserve banks. But wait, since there are 12 regional presidents, how do they determine who gets to vote?
It's a rotation. One seat is permanently assigned to the president of the Federal Reserve Bank of New York.
Why New York?
Well, this is a practical necessity because the New York branch is uniquely situated on Wall Street. They are the ones who execute the actual market operations and trades on behalf of the entire system.
Oh, that makes sense.
Yeah, and the other 4 voting seats rotate annually among the remaining 11 regional bank presidents. So at any given FOMC meeting, you have a blend of politically insulated Washington appointees and regionally focused banking leaders making the decisions collaboratively.
On paper, this structure is an elegant masterpiece of checks and balances. But our deep dive material brings up a very recent, highly contentious, real-world stress test of this exact structure.
Oh, yes.
Specifically regarding that concept of insulation from political pressure we just talked about. We're looking at events stretching into 2025 and 2026 during the second Trump presidency.
Yeah. The documentation provides a profound case study of the tension between the executive branch of the government and the mandated independence of the Federal Reserve. We need to examine the facts exactly as they're laid out in the legal and historical record, maintaining complete analytical impartiality, of course.
Absolutely. Here's the situation. President Trump attempted to remove Governor Lisa Cook from the Board of Governors before her 14-year term was completed.
Right.
Now, the Federal Reserve Act states that a president can only remove a governor for cause. It's not like firing a cabinet secretary over a policy disagreement. For cause historically implies a rigorous legal standard.
Usually involving severe ethical breaches, malfeasance, or criminal behavior. It means you cannot fire a governor just because they refuse to lower interest rates when you ask them to.
Right. And according to the source material, the president formally cited alleged misconduct as the justification or the cause for her removal.
And Governor Cook immediately and categorically disputed these allegations. Her position was that the dismissal was entirely unlawful, that it was fundamentally politically motivated to alter the balance of the board. And she subsequently filed a federal lawsuit to contest the removal.
And the fascinating mechanical reality is that as of the 2026 data in our sources, while this massive constitutional litigation slowly plays out in the federal courts, Lisa Cook is legally still considered an active sitting governor.
Yeah, the Federal Reserve itself even issued an official statement affirming her status as a governor pending a final judicial ruling.
Which is pretty incredible.
The implications of this are staggering for administrative law. I mean, the core question before the courts is who gets to define for cause and how broad is that definition?
Right. If the judiciary rules in favor of the president, essentially allowing the executive branch wide latitude to determine what constitutes cause, then those 14-year term limits are functionally gutted.
Exactly. And the Fed's independence is drastically reduced because future presidents could simply allege misconduct to clear the board.
But conversely, if the courts side with the governor and apply a strict, narrow definition of cause, that 14-year insulation is fortified, cementing the Fed's operational autonomy against the executive branch.
It's a massive stress test. And to add another layer of operational complexity, the source also details the situation regarding Governor Stephen Miron.
Oh, right, the holdover situation.
Yes, his official 14-year term on the board expired on January 31st, 2026. However, he didn't just pack up his desk and leave.
Why not?
Because the statute governing the Fed includes a provision stating that a governor can continue to serve after their term expires until a successor is officially appointed by the president and confirmed by the Senate. So he is remaining in his seat indefinitely.
Both of these scenarios, a governor actively fighting removal in federal court to protect her term, and a governor lingering indefinitely past his term waiting for the political appointment process to function. They demonstrate that the structure of the Federal Reserve isn't merely theoretical.
Not at all. It is a living institution operating within a highly charged, relentless political reality. The delicate balance between democratic accountability and independent monetary policy is constantly being tested and redefined.
So, we've established who is sitting in the driver's seat, and we understand the intense political gravity they have to resist. But how exactly do they steer this multi-trillion-dollar machine? When the FOMC meets, what exactly are they trying to achieve?
They're executing what Congress explicitly mandated them to do. In the amended Federal Reserve Act, Congress gave the Fed what is universally known as the dual mandate.
The dual mandate.
Right. They are tasked with two primary objectives for national monetary policy: maximizing employment and stabilizing prices.
Now, at first glance, that sounds fantastic. It sounds like a political campaign promise. I mean, everyone wants to have a well-paying job, and nobody wants their grocery bill to double every 6 months.
Sure.
But if you think about how economics actually works, those two goals frequently pull in completely opposite directions. They're often in direct conflict.
Precisely the problem. Let's trace the logic. When employment is maximized, when the economy is running incredibly hot, businesses are expanding, everyone who wants a job has one, and companies are raising wages to attract scarce talent. Everyday people have significantly more disposable income.
They go out and buy cars, they renovate their homes, they take vacations.
Exactly. That massive surge in consumer demand allows businesses to raise their prices because people are willing and able to pay. And that rapid price increase is inflation.
Right.
Conversely, if the Fed wants to cool down inflation and stabilize prices, the primary method is to make borrowing money more expensive. This slows down business expansion, which leads to hiring freezes or layoffs, which increases unemployment. Managing the dual mandate is a constant, agonizing tightrope walk.
I want to zoom in on the second half of that mandate, stabilizing prices, because the language is a little deceptive. When the Federal Reserve says stable, they absolutely do not mean zero inflation, do they?
No, they
They
don't.
don't want the price of a gallon of milk to stay at $3.50 for the next 50 years.
That is correct. The Fed interprets the mandate of stable prices as an ongoing inflation rate of exactly 2% per year on average over the long term.
2%.
Right. They track this primarily using a specific metric called the Personal Consumption Expenditures Price Index, or the PCE, which measures the changing prices of goods and services consumed by households.
But I think a lot of listeners might struggle with this concept. I mean, if inflation destroys the purchasing power of my dollar, why is the goal 2%? Why wouldn't zero inflation, where prices never go up, be the absolute ideal scenario for the American consumer?
It is deeply counterintuitive, I know. But most mainstream macroeconomic theory favors a low, steady rate of inflation for a few vital mechanical reasons.
Okay, let's hear them.
First and foremost, a 2% target acts as a crucial buffer. If your goal is strictly 0% inflation, any slight, unexpected economic downturn could easily tip the economy into negative inflation, which is called deflation.
And on a micro level, deflation sounds amazing. If I want to buy a new refrigerator and prices are dropping, that's great for me. But macroeconomically, deflation is a nightmare.
Right. A total nightmare.
Because if you know the refrigerator is going to be 10% cheaper next month, you don't buy it today. You wait. Everyone waits.
Exactly. When consumers expect prices to fall, they postpone purchasing. The appliance store's revenue plummets. They stop ordering inventory from the factory. The factory's profits crash, so they lay off workers.
And those unemployed workers stop spending entirely.
Right, which causes even more businesses to lose revenue. It creates a devastating, self-reinforcing death spiral. Deflation can also lead to what economists call a liquidity trap, where interest rates hit zero, but people still won't borrow or spend, rendering the Fed's primary tools completely ineffective. So a 2% inflation target keeps us safely away from that black hole.
You hear advisors to the Fed, like Diane C. Swonk, who is quoted in our source materials, compare inflation to a medical condition. She says, and I quote, "From the Fed's perspective, you have to remember, inflation is kind of like cancer. If you don't deal with it now with something that may be painful, you could have something that metastasized and becomes much more chronic later on."
It is a grim but accurate metaphor. The medicine for high inflation is economic pain. You have to actively slow the economy down, which means people lose jobs and businesses fail.
The tightrope walk again.
Exactly. The Fed believes that enduring a little bit of pain early on is vastly preferable to letting hyperinflation take root, which would require catastrophic economic chemotherapy down the line.
So what does this all mean? We know the target is 2%, but how does the Fed actually hit that target? They don't have a dial in Washington that directly controls the price of eggs.
No, they don't.
They have to influence the behavior of hundreds of millions of people and millions of businesses.
They do this indirectly, primarily by targeting something called the federal funds rate, or the FFR.
Okay, we need to trace the mechanical domino effect here, step by step.
Yeah.
What exactly is the federal funds rate?
To understand the FFR, we have to go back to the concept of reserves. Remember that private banks are required, or financially incentivized, to keep reserves parked at their local Federal Reserve Bank.
Right.
At the end of every single business day, the banking system has to balance its books, like closing out a cash register at a massive restaurant.
Makes sense.
Some banks will have taken in lots of deposits and have excess reserves sitting idle. Other banks might have issued a ton of loans that day and find themselves slightly short of their internal targets or legal requirements. So, to balance everything out, the banks with excess cash lend it to the banks that are short.
And these are incredibly short-term loans, right? Literally overnight. They lend the millions at 5:00 p.m. and get it back the next morning.
Correct. The interest rate that these private commercial banks charge each other for these unsecured overnight loans is the federal funds rate.
But here's the critical distinction that often gets lost in the news. The Federal Reserve does not explicitly dictate or mandate this exact rate. It's an open market rate.
Right. It is determined by banks negotiating with other banks. What the Fed does is set a target range for the FFR. They announce to the world, we want the overnight lending rate to hover between 4.5% and 4.75%.
And this is where the first domino falls. If the Federal Reserve takes action to push that FFR target higher, It suddenly becomes more expensive for a private bank to borrow the money it needs to cover its daily operations.
And banks are businesses. They do not just absorb that increased cost of doing business, they immediately pass it on to the consumer.
Right.
If it costs a major bank more to borrow money overnight, they are going to raise the prime rate, the baseline interest rate they charge their best, most creditworthy corporate customers. And when the prime rate goes up, everything else goes up. Mortgage rates climb, credit card interest rates spike. The APR on a new car loan gets more expensive.
And this is how the Fed steers the macroeconomy. When borrowing becomes expensive across the board, the behavior of consumers and corporations changes.
Exactly.
If a 30-year mortgage leaps from 3% to 7%, millions of families can no longer afford the monthly payment, so they don't buy the house. The housing market cools.
Right. And if a corporation's cost to borrow capital doubles, they cancel plans to build a new factory or hire 1,000 new workers. Because borrowing is expensive, spending slows down.
Demand across the entire economy cools off. And when demand cools, when fewer dollars are chasing the same amount of goods, businesses can no longer aggressively raise prices. Consequently, the rate of inflation goes down.
It is an incredibly powerful, indirect steering mechanism. You change the cost of overnight money for banks, and 6 months later, it alters the trajectory of a family buying a minivan.
But it brings up a huge mechanical question. If the Fed doesn't just push a magic button to legally set the FFR, because again, it's determined by the free market of banks lending to each other, what specific tangible tools does the Fed use to manipulate that free market so that the banks naturally arrive at the Fed's target range?
This brings us into the Federal Reserve's toolkit. And according to the historical data in our source material, to understand how they do it today, we have to understand a massive paradigm shift that fundamentally altered the plumbing of the financial system. We have to discuss the transition from a limited reserves regime to an ample reserves regime.
Let's start with the old school method, how things worked before the 2008 financial crisis. This was the era of the limited reserves regime. Back then, the Fed's primary tool was something called open market operations, or FOMO.
Right, FOMO.
Walk me through the mechanics of a transaction. The Fed decides they want to lower interest rates to stimulate a sluggish economy. What physical actions do they take?
In a limited reserves environment, the total amount of cash sitting in the reserve accounts of all the banks is relatively small. It is a scarce resource.
Oh.
So the Fed controls the federal funds rate by manipulating the supply of that scarce resource.
How?
They do this by actively buying or selling U.S. Treasury securities government bonds on the open market.
Okay, so the Fed wants to lower rates. They go to the open market, specifically dealing with a select group of major financial institutions called primary dealers. And they say, we want to buy billions of dollars worth of U.S. Treasuries from you. How do they pay for them? Do they send a truck full of physical cash?
No, it is entirely electronic. When the Fed buys those Treasury bonds from a primary dealer, they pay for them simply by electronically crediting the reserve account that the dealer's bank holds at the Federal Reserve.
Wait, they just make it up?
They literally type the numbers into a computer, creating the money out of thin air, and deposit it into the bank's account.
So they instantly inject a massive amount of new cash directly into the banking system.
Yes, and because reserves were previously limited, this sudden influx of cash changes the math. Now the banking system has an abundance of reserves.
Supply and demand.
Exactly. According to the basic laws of supply and demand, when the supply of something increases, its price goes down. In this case, the price of reserves is the interest rate banks charge each other to borrow them. Because every bank suddenly has plenty of cash, they have to lower the interest rate they charge to entice anyone to borrow from them.
And the federal funds rate drops.
Precisely. Conversely, if the Fed wanted to raise rates, they would sell treasuries, pull cash out of the bank's accounts as payment, making reserves scarce again, which drives the overnight borrowing rate up.
I think of it like a municipal plumbing system. The Fed has a master valve. They open the valve to flood the pipes with cash to lower the pressure, or they drain cash out of the pipes to increase the pressure and make money tight.
That's a great way to visualize it.
But that was the elegant old school way. Post-2008, the entire nature of the plumbing fundamentally changed.
It was a tectonic shift. During and after the 2008 financial crisis, the Fed injected trillions of dollars into the banking system to prevent a total collapse, which we will discuss in depth shortly. The consequence of that rescue was that the banks became absolutely flooded with cash permanently. Reserves were no longer scarce, they were ample.
So the old tool basically broke. If I have a massive reservoir that is overflowing with water, and you come along and dump one bucket of water into it or take one bucket out, it doesn't change the water pressure at all.
Exactly. If banks already have trillions more in cash than they know what to do with, the Fed buying or selling a few $1 billion in treasury bonds through open market operations isn't going to move the needle on supply and demand. The old method couldn't steer the FFR anymore.
So what did they do?
They needed a new school tool to operate in an ample reserves regime. And the primary modern tool became a mechanism called interest on reserve balances, or IORB.
This mechanism is conceptually fascinating. Because reserves are now ample, the Fed decided to start directly paying banks an interest rate just to keep their money safely parked at the Federal Reserve.
Right. It is an administered rate. It's not negotiated on an open market. It is set explicitly by the Federal Reserve Board of Governors. If the Fed wants to raise the federal funds rate today, they simply raise the IORB rate.
The easiest way to conceptualize the IORB is to think of it like a minimum wage for bank money.
Oh, that's a good comparison.
Let's say the Fed wants the overnight lending rate to be around 3.6%. So they set the IORB at 3.65%. If you're the manager of a major commercial bank, the Federal Reserve is offering you a 100% risk-free, federally guaranteed return of 3.65% just to leave your excess cash sitting completely idle in your reserve account.
Right.
Are you ever, under any circumstances, going to take that cash and lend it to another private bank in the overnight market for a measly 3.5%?
Absolutely not. It would be a violation of fiduciary duty. No rational financial institution would take on the counterparty risk, however slight, of lending to another private bank for a lower return than they can get absolutely risk-free from the sovereign central bank.
So by simply raising the IORB, the Fed instantly drags the entire federal funds rate up with it.
Yeah.
It sets an impenetrable floor under the market.
Exactly. The banks will never lend to each other for less than they can get from the Fed. It is an incredibly clever, direct way to steer a flooded market without having to drain the floodwaters first.
It's the primary steering mechanism of the modern era. But it's not the only tool they use to manage this corridor, right? While the IORB sets the floor, they also have a backup mechanism called the discount window.
Right. Let's look at the discount window. If IORB is the floor, the discount window acts as the ceiling.
How does it work?
The discount window is a standing lending facility. The Federal Reserve will lend money directly to depository institutions. The interest rate they charge for these loans is the discount rate, formerly known as the primary credit rate.
And how is that rate set?
The Fed generally sets this discount rate at a premium, typically about 100 basis points or 1 full percentage point above their target federal funds rate.
Okay, so if the Fed's target for the overnight market is 3.5%, they might set the discount rate at 4.5%.
Exactly. The intentional premium is designed to encourage banks to borrow from each other in the open market first. It is cheaper to borrow from your neighbor than from the central bank.
That makes sense.
But if there is a sudden localized shock, or a specific bank desperately needs cash at the end of the day, and no other private bank is willing to lend to them, they can always go to the Fed as a last resort.
Which puts a natural ceiling on rates.
Right, because no bank in their right mind would agree to borrow from another private bank at an extortionate rate of 5% if they know they can just walk over to the discount window and borrow from the Fed at 4.5%.
So the IRB pushes the rate up from the bottom, the discount window pushes it down from the top, and the FFR stays happily bouncing around in that narrow channel.
Precisely.
Now, speaking of the tools banks use, there's a detail hidden in this section of the source material that completely upends a concept taught in basic economics classes.
Oh, what's that?
Well, we spent the beginning of this deep dive talking about fractional reserve banking and how the defining feature of a bank is that they are legally required to hold a specific percentage of their deposits in liquid reserve, the required reserve ratio.
Yes, the required reserve ratio. Historically, adjusting that ratio was a blunt instrument used by the Fed to control the money supply.
Yeah.
If they raised the requirement from 10% to 15%, banks instantly had less money to lend out, tightening the economy.
Historically being the operative word. Because the text notes that in March 2020, as part of the chaotic response to the onset of the COVID-19 pandemic, the Federal Reserve dropped that required reserve ratio to zero, literally 0%.
Yes, they did.
As we speak today, commercial banks in the United States are legally required to hold 0% of their customers' deposits in reserve.
It sounds incredibly alarming, almost reckless when you first hear it. It sounds like they removed the fundamental safety net of the banking system.
It really does.
But you have to view this change strictly within the context of the ample reserves regime we just discussed. Because the Fed was already flooding the entire financial system with massive amounts of liquidity and actively paying high interest, the IORB, to banks to keep excess cash parked at the Fed, the actual legal mandate became obsolete.
Oh, I see.
Banks were naturally, voluntarily holding vastly more reserves than the old legal requirements dictated just to earn that risk-free interest. So the Fed simply zeroed out the legal requirement to free up administrative overhead, though the statutory framework absolutely still exists to reinstate it at any time if conditions change.
It is a perfect example of how fundamentally the actual mechanics of central banking have mutated over the last 2 decades. These tools we've explored, the IORB setting the floor, the discount window setting the ceiling, the open market operations humming in the background to ensure the reservoir stays full, they are highly effective for everyday steering.
They keep the economic car on the road.
Exactly. But what happens when the road falls away completely? What happens when a black swan event hits and the entire financial system faces catastrophic systemic collapse?
That is the moment when the Federal Reserve steps away from tweaking interest rates and deploys its ultimate original superpower, acting as the lender of last resort. When the normal everyday transmission mechanisms of monetary policy freeze and completely break down, the central bank has to aggressively intervene to prevent the absolute destruction of the global economy.
And our source provides a harrowing step-by-step look at exactly what this looks like in practice, specifically zooming in on the dark days of the 2008 financial crisis.
This was a nightmare scenario for policymakers.
It originated with the subprime mortgage crisis and the spectacular bursting of the U.S. housing bubble. Suddenly, massive Wall Street financial institutions woke up and realized that the trillions of dollars of mortgage-backed securities they were holding on their balance sheets were essentially toxic waste.
We should briefly clarify the mechanics of a mortgage-backed security, or MBS, to understand the panic.
Yeah, let's do that.
In the years leading up to 2008, a local bank would issue a mortgage to a family. Instead of keeping that loan, the bank would sell it to Wall Street. Wall Street firms would take thousands of these individual mortgages from all over the country, bundle them together into a massive pool, and sell slices of that pool to global investors as a single bond, an MBS.
The logic was that while one family might default on their home, it was statistically impossible for thousands of families across different states to all default at the exact same time.
Right.
So the rating agencies stamped these bonds as AAA, perfectly safe, risk-free investments. Pension funds, international banks, and insurance companies bought them by the truckload.
But there was a fatal flaw.
What was it?
Wall Street had run out of good mortgages to bundle, so they started bundling subprime mortgages loans given to people with terrible credit, no verified income, and adjustable interest rates. When the housing market stopped going up and those adjustable rates suddenly reset higher, millions of people defaulted simultaneously. The statistically impossible happened.
And the fear generated by those defaults was highly contagious. Because these toxic MBS bonds were interwoven into the balance sheets of almost every major financial institution on Earth, no one knew who was solvent and who was secretly bankrupt.
Exactly. Banks looked at each other and thought, I don't know if you're holding billions in worthless mortgages, so I am not going to lend you money. The interbank lending market, the very mechanism that determines the federal funds rate we just discussed, completely and totally froze out of sheer terror.
But wait, this brings up an obvious question.
Yeah.
Earlier, we established that this exact scenario is what the discount window is designed for. If private banks are too terrified to lend to each other overnight, they're supposed to just walk over to the Federal Reserve and borrow from the discount window to stay afloat.
Right. In textbook theory, yes. But in the brutal reality of 2008, the discount window was utterly failing. The source material explains this failure was driven by a powerful psychological phenomenon known as the stigma of bank failure.
The optics of desperation.
Yes. If you are the CEO of a massive, prestigious Wall Street investment bank, and the market finds out you had to go to the Fed's discount window to beg for emergency cash just to keep your lights on, it sends a flare up to the entire world that you are financially radioactive.
If you use the safety net, your clients will panic, pull all their money out of your bank the next morning, and your stock will plummet to zero.
Exactly. So out of pride and self-preservation, banks absolutely refuse to use the Fed's emergency tools.
And because the banks refused to borrow, the liquidity crisis reached a breaking point. The text highlights a very specific, staggering intervention that illustrates the sheer scale of the panic. On September 16, 2008, the Federal Reserve Board of Governors authorized an $85 billion emergency loan to the American International Group, commonly known as AIG.
Now, AIG is an international insurance giant. They are not a traditional depository bank.
Right. Why on earth did the central bank step in to bail out an insurance company?
Because AIG had essentially written insurance policies called credit default swaps on billions of dollars of those toxic mortgage-backed securities for institutions all over the world, they had promised to pay out if the mortgages defaulted.
Oh, wow.
When the housing market collapsed, AIG was suddenly on the hook for tens of billions of dollars they did not have. If AIG was allowed to declare bankruptcy, they would default on all those insurance payouts. The international banks relying on that insurance would instantly become insolvent.
So it's a domino effect.
The Fed realized that AIG's collapse would trigger a domino effect that would bring down the entire global financial system like a house of cards. So the Fed, in emergency coordination with the U.S. Treasury, stepped in with $85 billion to stave off that specific bankruptcy.
But throwing $85 billion at AIG wasn't enough to unfreeze the wider system.
Yeah.
Because the traditional discount window was crippled by stigma and banks still wouldn't lend to each other, the Fed realized they had to invent entirely unconventional weapons.
They had to bypass the frozen interbank market and pump cash directly into the veins of the economy.
This brings us to a massive controversial tool, quantitative easing, or QE.
Under standard limited reserve open market operations, the Fed traditionally only bought short-term, incredibly safe U.S. Treasury bills to slightly adjust the money supply. Under the emergency protocol of quantitative easing, the Fed drastically expanded the scope and scale of its purchases.
In November 2008, crossing a historic Rubicon, the Fed announced it would start buying the toxic mortgage-backed securities directly from the struggling financial institutions.
The numbers in the source are staggering. Over the course of the crisis, the Fed bought $1.25 trillion in mortgage-backed securities.
Let that number sink in. That was roughly 1/5 of all U.S. government-backed mortgages in existence at the time. The central bank was literally acting as a giant vacuum cleaner, sucking up the toxic assets that no private investor would touch, just to forcefully inject cash into a crashing housing market and artificially stabilize prices.
It was unprecedented.
Now, I have to pause and push back on this, because reading through this section of the history is where a huge portion of the American public gets incredibly frustrated and, frankly, angry with the Federal Reserve.
Sure.
If the central bank can just step in with an infinite blank check, buy up trillions in toxic debt, and bail out massive institutions that made terrible, greedy, reckless bets on subprime mortgages, aren't they just printing money to reward bad behavior? Doesn't this create a massive, systemic moral hazard?
It's a very fair question.
I mean, if I am a Wall Street CEO and I know the Fed will unconditionally save me if my massive gamble fails, why wouldn't I take insane risks to maximize my bonuses? Where is the accountability?
If we connect this to the bigger picture, you have perfectly articulated the central agonizing dilemma of a central bank operating in a crisis. The economists at the Fed are acutely aware of the concept of moral hazard. They know that bailing out reckless actors encourages future recklessness.
Right.
But in September 2008, they were not sitting in a seminar room debating theoretical economic models. They were looking over the edge of a genuine abyss.
Their argument is that they had to make a horrific choice. Let the bad actors fail and suffer the righteous consequences, but allow the entire global payment system to collapse with them, taking the innocent public down too. Or save the system, keep the lights on, and hold their noses while the bad actors essentially got bailed out.
That is the grim reality of the situation. If the global payment system actually collapses, the consequences are apocalyptic for the average citizen. ATMs stop dispensing cash. Corporate payrolls don't clear the banks, so millions of workers don't get paid on Friday.
Grocery stores cannot secure short-term credit to buy food inventory, leading to empty shelves within days. The real physical economy halts.
Right. So the Fed leadership decided that ensuring the immediate physical survival of the economic system vastly outweighed the long-term philosophical risk of moral hazard. And to get that money flowing quickly to the specific sectors that were suffocating without triggering the toxic stigma of the discount window, they created a massive alphabet soup of temporary, highly targeted emergency lending facilities.
The alphabet soup. The source document lists so many of these acronyms, it makes your head spin. They basically set up these specialized, sometimes anonymous mechanisms to inject cash precisely where the arteries were blocked. Let's look at two notable examples from the text. the TALF and the CPFF.
Okay, the TALF stands for the term Asset-Backed Securities Loan Facility. The goal here was to save the consumer credit market. The Fed provided loans to investors specifically to encourage them to buy newly issued asset-backed securities tied to everyday things: auto loans, student loans, and credit card receivables.
So the Fed was trying to unfreeze the consumer lending pipelines so that normal people could still get a loan to buy a car to get to work or take out a student loan to go to college.
Exactly. And then there was the CPFF, the Commercial Paper Funding Facility. This one is mechanically fascinating because it represents a massive expansion of a central bank's traditional role. Through the CPFF, the Federal Reserve essentially bypassed the banking system entirely and became a direct lender to non-financial corporations.
To understand why this was necessary, you have to understand commercial paper. Large corporations, let's say an automaker like Ford or a massive retailer like Target, do not keep billions of dollars in cash just sitting idly in a checking account to pay their weekly bills. They invest their cash.
Right.
So when they need $50 million in liquid cash on a Wednesday to make their massive employee payroll on Friday, they issue short-term debt called commercial paper. They borrow the $50 million from money market funds for a few days, pay their workers, and then repay the debt on Monday when their weekend retail receipts clear the bank.
It's the circulatory system of corporate America. But in the autumn of 2008, fear was so high that investors completely stopped buying commercial paper. The market froze. Without that short-term cash, major corporations were days away from bouncing payroll checks, which would have triggered immediate mass layoffs across the country. So the Fed stepped in, created the CPFF, and said, fine, if the open market won't buy your commercial paper, the Federal Reserve will buy it directly. They lent out a staggering $738 billion through this specific program to keep corporate America's lights on.
And the really crucial point, the source notes, is that the CPFF wasn't just a one-time anomaly confined to the history books of 2008. When the COVID-19 pandemic triggered massive, unprecedented market disruptions and lockdowns in March 2020, the commercial paper market threatened to freeze again.
The Fed didn't hesitate. They immediately dusted off the 2008 playbook and reintroduced the CPFF to stabilize the flow of credit to households and businesses.
These radical crisis tools are no longer anomalies. They are becoming a permanent part of the standard operating playbook,
which represents a profound historic shift in the nature of monetary policy. But executing this modern playbook, buying trillions in mortgage bonds, bailing out insurance giants, funding corporate payrolls, and paying high interest to banks on their massive ample reserves, requires financial resources on a scale that is genuinely difficult for the human mind to comprehend.
Exactly. You can't just write these checks out of thin air without it showing up somewhere. Where does the Federal Reserve keep track of all this? And what happens when the bill inevitably comes due? This requires us to open up the books and look at the Federal Reserve's balance sheet.
Right. The Federal Reserve is required to publish its balance sheet every single week. It is a public accounting detailing all of the central bank's assets, what it owns, and its liabilities, what it owes. And over the last 15 years, the sheer size of this balance sheet has grown to staggering proportions.
According to the source data, the Fed's total assets peaked at over $7.7 trillion in 2021. As of August 2024, it was sitting at roughly $7.139 trillion with a T.
To put a number that large into perspective, $7 trillion is roughly equivalent to 1/3 of the entire annual gross domestic product of the United States. And if you look at the composition of those assets, it tells the entire financial story of the last decade and a half.
Where's that money?
The vast majority of that $7 trillion is held in U.S. Treasury securities and mortgage-backed securities, the exact assets they purchased by the truckload during multiple rounds of quantitative easing to artificially stabilize the markets in 2008 and 2020.
Now, a logical question arises. How does the Fed afford to buy $7 trillion worth of assets? Do they get a massive appropriation of taxpayer money from Congress every year?
No, they do not. The Federal Reserve is an entirely self-funded institution. They do not receive a budget from Congress.
Then how?
Over 90% of their revenue is generated organically from the interest they earn on that massive multi-trillion-dollar portfolio of Treasury and mortgage-backed securities they hold. They also generate a small amount of income from the fees they charge depository institutions for the financial services they provide, like clearing checks and transferring funds.
So if I am understanding the mechanics correctly, they have the unique power to digitally create money, They use that newly created money to buy interest-bearing government bonds, and then they collect the interest payments on the bonds they bought with the money they created.
Yeah.
It is an incredibly lucrative setup if you can get the charter for it.
It is a totally unique sovereign position. And historically, because of this dynamic, the Federal Reserve has been incredibly profitable. The law dictates a very specific waterfall for those profits. First, the Fed pays for all of its own operating expenses, staff salaries, maintaining the regional banks, printing the physical currency.
Second, they pay out that legally mandated 6% dividend to the private member banks we discussed earlier.
Finally, by law, they must remit all the massive remaining excess profits directly back to the U.S. Treasury.
And these remittances used to be a massive boon for the federal government. The source notes that in 2015, during a period of relative stability, the Fed earned a net income of $100.2 billion. After expenses, they transferred a staggering $97.7 billion directly into the Treasury's coffers.
That is almost $100 billion of revenue that essentially reduced the national deficit just handed over by the central bank.
That highly profitable dynamic was the reliable status quo for a very long time. But the deep dive material reveals a massive, surprising plot twist that occurred in the accounting books in 2023, a complete reversal of fortune.
Right. To understand why they started losing money, we have to look at how they fought the recent inflation spike. Remember how the Fed fights inflation in an ample reserves regime?
They raised the IORB, the interest rate they pay to commercial banks to park their cash.
In 2022 and 2023, to combat the severe post-COVID inflation, the Fed had to raise those interest rates aggressively and dramatically. At the exact same time, they initiated a process called quantitative tightening, or QT.
Quantitative tightening is the mechanical reverse of quantitative easing. Instead of buying bonds to pump money into the economy, the Fed starts shrinking its balance sheet to pull money out of the economy.
They do this by letting those trillions in bonds mature without replacing them, or by actively selling the bonds back onto the open market. But here is the catch. Because the Fed had aggressively raised interest rates, the older bonds they were holding, which were issued years earlier at much lower interest rates, became significantly less valuable.
Let's make sure that concept is totally clear, because the inverse relationship between bond prices and bond yields trips up a lot of people.
It's true.
Imagine the Fed bought a 10-year Treasury bond back in 2020 that pays a 2% yield. It pays $20 a year. But now it's 2023. The Fed has raised rates to fight inflation, so brand new Treasury bonds being issued by the government are paying a 5% yield, or $50 a year.
Right.
If the Fed wants to sell its old 2% bond on the open market to shrink its balance sheet, no investor is going to pay full price for a bond that only yields $20 when they could just buy a new one yielding $50. To convince an investor to buy the old bond, the Fed has to sell it at a steep discount, taking a loss on the principal.
Exactly. So you had two massive financial forces colliding on the Fed's balance sheet in 2023. First, their expenses skyrocketed because they were suddenly paying out billions in high-interest IORB payments to commercial banks. Second, the value of their multi-trillion-dollar portfolio dropped, and they were taking losses on the bonds they were selling off.
The result. In 2023, the Federal Reserve reported a record net negative income of $114.3 billion. They operated at a staggering $100 billion loss.
It's wild to think about.
Now, if a private corporation like Amazon or General Motors loses $114 billion in a single year, they're instantly insolvent. They go bankrupt, their stock goes to zero, and they liquidate. But the Federal Reserve does not go bankrupt. They survive using a very specific, almost magical accounting quirk.
The central bank employs an accounting mechanism called a deferred asset. When the Federal Reserve takes a net operating loss, it does not declare insolvency. Instead, it simply creates a new liability line item on its balance sheet called a deferred asset. In the 2023 case, this massive loss was booked as an interest on Federal Reserve notes due to U.S. Treasury liability, totaling $133.3 billion.
So in plain English, they just take a pen and write down $133 billion IOU to themselves on the ledger.
Essentially, yes. What this deferred asset means in practical terms is that the Federal Reserve will not remit a single dollar of profit to the U.S. Treasury until they generate enough future net income to completely pay down the $133 billion deferred asset.
Wow.
Based on the source's projections, the Fed will likely not resume its regular remittances to the Treasury until roughly 2027 or beyond. Now, having a massive deferred asset does not legally or mechanically stop the Fed from conducting monetary policy. They can still set interest rates and buy bonds, but it serves as a glaring mathematical testament to the sheer terrifying scale of the financial forces they are attempting to manipulate.
and wield that much absolute, unchecked financial power, the ability to unilaterally create trillions of dollars, buy up massive sectors of the bond market, bail out failing global corporations, set a floor on global interest rates, and casually absorb a $133 billion operating loss with an accounting trick, inevitably draws intense, passionate criticism.
Yeah, truly.
And our source material covers these critics extensively. We're going to impartially report on these diverse viewpoints because to truly understand what the Fed is, you have to understand the strongest arguments against its very existence.
This raises an important question then. The criticism of the Federal Reserve is not monolithic. It comes from multiple, often opposing economic and political perspectives. Let's start by examining the monetarist critique, which is most famously represented by the late Nobel laureate economist Milton Friedman.
Friedman's core argument was that the Fed doesn't just awkwardly try to solve economic crises. Its clumsy interventions are often the primary cause of them. The source explicitly highlights his famous controversial analysis of the Great Depression.
Right. Friedman, along with Anna Schwartz, painstakingly argued that the crash of 1929 did not have to become a decade-long depression. He believed the Fed caused the severity of the Depression because they inappropriately and stubbornly refused to lend money to small, struggling banks during the bank runs of the early 1930s.
Instead of acting as the expansive lender of last resort they were designed to be, they actually tightened the money supply, allowing a third of the nation's banks to fail and starving the economy of liquidity when it needed it most.
And modern monetarists apply a very similar analytical lens to more recent events. The source points out that many contemporary economists squarely blame the Federal Reserve's prolonged zero-interest rate policies and their massive sustained quantitative easing campaigns during the COVID-19 pandemic for directly causing the massive, painful inflation spike that followed in 2022.
The monetarist argument is straightforward. The Fed kept the emergency money spigot wide open for far too long, flooding the system with too much cheap cash. That excess liquidity chased a constrained supply of goods, inevitably inflating massive asset bubbles in real estate and the stock market and drastically driving up consumer prices.
Then, moving to a different flank, there is the Austrian economics perspective, which is championed heavily in modern political discourse by libertarian figures like former Congressman Ron Paul. This critique is much more fundamental and radical. They don't just want the Fed to tweak its mathematical formulas or change its target rates. They advocate for the total abolition of the central bank.
The Austrian critique centers primarily on the dangers of fiat currency. To understand this, we have to look back to 1971, when the Nixon administration officially closed the gold window, completely severing the U.S. dollar's tie to physical gold. Since then, the dollar has been a pure fiat currency, meaning its value is backed by nothing physical, only the full faith and credit of the U.S. government.
Ron Paul and the Austrian school argue that allowing a centralized, unelected committee to arbitrarily manipulate the supply and price of a fiat currency is inherently destructive. They argue it inevitably causes long-term insidious inflation that robs savers of their wealth, and it artificially engineers devastating boom and bust economic cycles by distorting natural market interest rates.
The text specifically mentions Ron Paul's influential book, End the Fed. In it, he argues that the central bank not only undermines true economic stability, but it serves as a mechanism that unfairly enriches a politically connected banking elite at the direct expense of the general public.
There is a powerful populist argument embedded here regarding the wealth gap. Think about the mechanics of quantitative easing. When the Fed prints trillions of dollars and buys assets, that new money enters the economy through massive financial institutions. It instantly inflates the prices of assets like stocks and real estate.
So if you are wealthy and own a massive stock portfolio and multiple homes, your net worth skyrockets. But if you are a working-class citizen who rents an apartment and lives off an hourly wage, you don't see those massive asset gains. You just see the resulting inflation eating away at your purchasing power at the grocery store. Critics argue the Fed's policies mathematically exacerbate wealth inequality.
This profound concentration of power, combined with the opaque nature of their interventions, raises an incredibly important question regarding transparency and democratic accountability. This is another major vector of criticism detailed in the source.
Right. Now, the Federal Reserve is technically audited by the Government Accountability Office, the GAO, but the source explicitly and importantly clarifies that these GAO audits are heavily restricted by law. They're essentially limited to administrative functions.
Right. They explicitly do not cover the Fed's actual market-moving monetary policy actions. The GAO is not allowed to audit discount window lending records or the specifics of open market operations or communications with foreign central banks.
The Fed's institutional defense is that they desperately need that veil of secrecy to maintain their operational independence and to prevent market panic. If the public knew exactly which banks were borrowing emergency funds in real time, it would trigger those fatal bank runs we discussed earlier.
But critics argue that an institution wielding trillions of dollars in public, sovereign power simply cannot be allowed to operate in the shadows of a democratic society. The source provides a wild, high-stakes example of this exact tension, the Bloomberg FOIA lawsuit.
It is a landmark case for financial transparency. During the darkest days of the 2008 crisis, the Fed loaned out trillions of dollars through that alphabet soup of emergency facilities we discussed, the TALF, the CPFF, and others. But they absolutely refused to disclose which specific banks and corporations were receiving this taxpayer-backed lifeline, or what highly questionable collateral those banks were pledging in return for the cash.
Bloomberg News filed a Freedom of Information Act lawsuit to force the central bank to open its books and reveal the details of the bailouts.
And the Fed fought this transparency demand tooth and nail. They litigated it for years, fighting it all the way to the United States Supreme Court, utilizing the exact argument you just mentioned, that revealing the names of the borrowing banks would stigmatize them and cause a renewed run on the financial system.
Bloomberg ultimately won the case in 2011, forcing the Fed to release thousands of pages of detailed transaction data.
But for the critics, the mere fact that it required a multi-year, multi-million-dollar Supreme Court battle just for the American public to find out exactly where trillions of dollars of emergency funding went is a massive, glaring indictment of the institution's systemic lack of accountability.
It perfectly encapsulates the enduring paradox of the Federal Reserve. We demand that they possess the absolute power and secrecy necessary to act decisively in a crisis to save the economy, but we deeply resent the unaccountable, undemocratic nature of that exact same power.
Okay, we have covered an immense, staggering amount of ground in this deep dive. We started by standing in the grocery store, wondering why the price of milk was fluctuating, and we ended up analyzing Supreme Court battles over multi-trillion-dollar secret balance sheets. Let's try to synthesize and summarize the massive high-wire balancing act that the Federal Reserve performs for you every single day.
It has been a remarkable, improvised evolution over the last century. It started in 1913 with a secret meeting on Jekyll Island to design a purely mechanical, limited solution to stop localized banking panics, a simple lender of last resort. Today, operating through a complex, hybridized structure of presidentially appointed public governors in D.C. and private regional banks across the country, it actively manages the very lifeblood of the global economy.
They execute this through their congressional dual mandate, striving to maximize employment so people have jobs, while simultaneously fighting the economic cancer of inflation by targeting a steady 2% rate. And they achieve this not by simply decreeing prices, but by subtly and powerfully manipulating the deep plumbing of the financial system.
We saw how they shifted paradigms, moving from a world where they bought and sold treasury bonds to tweak limited reserves, to our modern, cash-flooded reality where they simply set an impenetrable floor on all interest rates by adjusting the IORB.
And perhaps most significantly, we examine what happens when that system threatens to tear itself apart entirely, as it did in 2008 and again in 2020. In those moments, the Fed abandons its traditional boundaries. They buy toxic mortgage assets, they lend hundreds of billions directly to non-financial corporations to make payroll, they expand their balance sheet to over $7 trillion, absorbing the catastrophic risk of the private sector to keep the global payment system functioning, even if it results in logging a $100 billion deferred asset liability on their own books.
Which is a lot to process.
Here's where it gets really interesting and what I want to leave you as we wrap up. Because all of this historical context and mechanical explanation leaves us with a profound, almost philosophical question about the future of our economic system. Over the last 15 years, we have watched the Fed's balance sheet balloon to incomprehensible sizes. We have seen their radical break-the-glass emergency crisis tools like buying corporate debt, directly funding commercial paper, and essentially bailing out entire sectors of the economy increasingly become part of the standard operating procedure at the very first sign of a market disruption.
The historical line separating rare emergency intervention and permanent active market management has become incredibly, perhaps permanently blurred.
Exactly. So I want to leave you with this final provocative thought to ponder as you look at your next bank statement or grocery receipt. As the Federal Reserve continually expands its reach, essentially setting a permanent floor on global investments to prevent any major institutional collapse, have we fundamentally altered the definition of what a central bank actually is? If the ultimate lender of last resort is now actively buying up corporate debt and aggressively intervening to ensure the stock market doesn't fall too far and hurt retirement accounts, is there any truly free market left out there? Or are we all, from the high-frequency Wall Street trader moving billions, down to you deciding whether you can afford a carton of eggs? Just quietly trading inside the margins of the Federal Reserve spreadsheet.
It is arguably the defining economic question of our era. Because as long as the mandate to protect the economy remains, the tools they invent to fulfill it will continue to evolve in unprecedented ways.
And we will be right here to unpack those tools when they do. Thank you so much for joining us on this deep dive into the machine that runs the world. Stay curious, keep an eye on those interest rates, and we will see you next time.